Hello everyone and welcome to Fun with Fitzy. We are on 9.4, closing entries. So closing entries are also something we need to do. It's one of the last steps we do at the end of the accounting cycle. The time period concept is one of the gap concepts that we talked about already. It means that financial reporting, that means preparing your financial statements, or net income in particular, that's what we're after, is done in equal periods of time, which is fiscal periods. So either we look at it quarterly, monthly, but most often we prepare financial statements after 1 year. After you do your adjusting entries and prepare your formal income statements, the accounts must be made ready for the next accounting cycle. So we've done our adjustments, we brought our accounts up to date, and we've prepared our income statement. So we've done our revenue minus our expense, and we got our net income. Now in our next period, if we start off without doing our closing entries, we're going to have revenue and expenses already in the accounts, but we want to start fresh. We want those accounts to start with zero balances. So first thing we need to do is determine which accounts have balances that continue from one period to the next and which ones do not. So our assets, we always want to know how much we have in our assets, and our liabilities, we always want to know how much we pay. But our expense and revenue, we are calculating our net income for one period of time, usually a year. So each year we want to start fresh for those ones. So there are two types of accounts. The first one is called real accounts. They're also called permanent. And nominal accounts, which are called temporary. Kind of gives it away. They're temporary accounts because we want to restart them at zero. So all assets and liability accounts and capital. Assets, liability, and capital, the three accounts we started with at the beginning of the course, we're going to call them real accounts or permanent. Remember, we called them permanent. And we are not going to change them. We are not closing them. We will do nothing to them. Real accounts have balances that continue into the next fiscal period, and this makes sense. If we have cash for $1,000 in our account, of course, next fiscal period, we're going to have cash there for $1,000. We don't want it to be zero. We have $1,000 worth of cash. Nominal accounts, on the other hand, revenue, expense, and drawings. Now, drawings is a capital account, an owner's equity account. It does go on the balance sheet, but it is still nominal because we use it to update capital. And revenue and expenses go on the income statement, as you know, and we need to start fresh each year calculating how much revenue and expenses we had. All three of these accounts, revenue, expense, and drawings, have balances that do not continue into the next fiscal period. So we want them to go to zero. Okay, so again, I'll just reiterate, nominal accounts, sometimes they're called temporary, are related to the income statement, except for drawings. Drawings goes on the balance sheet. So a special nominal account called the income summary is going to be used, so we're going to create it. And it's used only during this closing process. And you'll see how we use that. But just remember, we're adding an account called income summary. And basically, it's a summary of our income because we're going to put our revenue and expenses in there. Once the income statement for a period has been completed, the balances in the nominal accounts, remember the temporary ones, are no longer useful. So again, I keep saying this, we need them to have zero. We want to start fresh for the next period. The next accounting cycle, we want them to start with zero. So we're going to close those accounts. Closing an account means to cause it to have no balance. And we've done things like this throughout the course. Any changes in equity during the period are contained in revenue, expense, and drawings accounts. Remember, our four owner's equity accounts. We have capital, which is a permanent account. We have revenue, expense, and drawings. These are our owner's equity accounts. We want these three to start fresh next period, and we want to update our equity by putting all of these amounts into our capital. Because remember our formula, beginning capital plus net income minus drawings equals ending capital. Well, guess what? We've been doing it all throughout this semester. on our balance sheet, but we've never actually updated our capital account. So our capital account is usually incorrect. So we need to update our capital account by closing the other three. So we're going to close our revenues, bring it to zero, close our expenses, bring it to zero, close our drawings, bring it to zero, and eventually our capital account will be updated. It'll be new, our new ending capital, and we'll have put our net income in there and our drawings. Closing these nominal accounts moves the values collected in these accounts into the one real, remember, real or permanent, we keep calling them now, equity account and its capital. So let's look at the entire accounting cycle. We know this already, and I've done this with you before. Transactions occur and the accountant gets a source document. So what we need to do is journalize those transactions. Then we have to post to our ledger, and posting, remember, means transferring our journal entries into our ledger, and we have to remember cross-referencing and forwarding. Then we balance our ledger by doing a trial balance to make sure our ledger is in balance, our debits equal our credits. Then we prepare our worksheet. Now we know our worksheet has the new adjustment columns on it. We're going to then prepare our income statement and balance sheet. Journalize and post the adjustments that were on your worksheet. You can do that before you do your income statement and your balance sheet as well. And then we're going to prepare closing entries, and we need to journalize and post our closing entries. So the next video will show you how to do those closing entries. And then it starts all over again after we do a post-closing trial balance. By the way, there are 3 trial balances. There's a trial balance here. There is an adjusting trial balance. You do a trial balance after you do your adjustments. And then there's a post-closing trial balance. So there's 3 trial balances. So by now you should be able to explain what the closing entries are and why we do them, and describe all of the steps of the accounting cycle. I hope this video helped, and we will see you in the next